Hello everyone, welcome back. My name is Greg Furman and this is the VantagePoint AI Market Outlook for the week of November the 4th, 2019. Now, to get started this week, we're going to begin where we always do with that very important US dollar index, but we will be looking at all of the major markets with a number of Forex pairs. Now, when we look at the US dollar, the dollar is a driving factor in equities, in gold, a number of different commodities. We can see here that we failed the level we talked about in last week's weekly outlook at the 97.68 area, and the dollar is rejected moving higher. Now, that doesn't mean that the dollar won't move higher in the days ahead. More specifically, we've come out from the FOMC. The FOMC is now saying that they are basically suggesting that they're going to pause. There's not going to be any more rate cuts. That's a dollar positive. When we also look at the non-farm payroll number on Friday, that too is a very strong dollar positive. That doesn't mean that demand for dollars will increase right away, but it doesn't mean that the dollar is going to sell off hard either. We can see that we have a very strong verified support level. That goes actually all the way down to this main level here at 96.55. Only a break of 96.55 would then take the pressure off the upside, actually, not the downside. Again, when we come into the bottom part of these ranges, 80% of the time we see a substantial bounce. Now, when we look at gold, the one thing we want to understand here with gold here is that gold has had a very, very good year, up at one point about 24% on the year. Very, very impressive. Now, when we look at the current state of gold here, what we want to make sure is that we're looking at everything. Now, in this particular section here, we can see that gold is in a channel. It's been in a channel here for basically about the last month and a half or so. But in 90% of the time, guys, whenever you come off a fairly large move, when we back our charts out here, we can see that we've got a pretty substantial move to the upside on gold. And most experienced traders will tell you that nothing goes straight up and nothing goes straight down, that the market is likely just pausing right now, getting ready for the next move, either up or down. But by the looks of the VantagePoint indicators, they've accurately basically told us we should be buying gold every time we dip down anywhere between basically the 1478 mark, or even if we're lucky enough to get 1465. But as you can see, the market has drawn a clear line in the sand that it has no interest in selling gold at this particular level. They are only interested in buying. Now, we do have some sellers up here still, and there's still formable resistance, but we don't want to be missing out on an opportunity to buy something. Even if gold moves from 1470, 1480 to 1505, that's a very good return on investment, and that's the way we should be looking at things. So again, when we look at these indicators right now, they're bullish to neutral, but we've got a fresh triple EMA cross. We just have to break through this resistance. Now, the Fed could cause problems with that, but again, when you look at gold here, guys, you want to ask yourself, has anything really changed here? Is the global economies, are they moving higher or are they moving lower? They're basically softening globally, right? Is there a trade deal with the US and China? No, there is not. They haven't even managed to sign a phase one deal yet, let alone settle the whole thing. Over the course of the weekend, China's been awarded $3.6 billion in tariffs from the WTO. So there's a number of different factors that absolutely support buying gold. So please don't, when you're looking at this, make sure you're looking at the broader picture here. And just because something is stalled or it's a little bit sideways here doesn't mean there isn't a buying opportunity. We can also assess here too that despite the equity markets moving higher, that has had zero effect on gold selling off. That's a fact. When we look at the charts, it's actually strengthened gold. So understanding these intermarket correlations, that one of these two prices is probably not right. By the look of it, we can see that we've got early warning signs in the VantagePoint software from the medium term crossing the long-term predicted difference, the predicted MACD trigger. They're all saying that the market is going lower. When we look at the predicted RSI, we're at 87.4, so not exactly the best place to be buying the S&P 500. And when we cross-reference that to the dollar, as of late, the strong intermarket correlation has actually been to the US dollar, not the euro. So basically, basically, if we believe that the US dollar is going to go lower, then the probability is the S&P 500 is going to go lower too. So try and keep that in mind, guys. Now, when we look at oil for next week, oil is basically an equity-based trade. We've had a big move up in oil, but has anything changed from last week? The answer is clearly no. We've still got a top in place here at the high at 56.92, and we have very strong verified support starting at 52.46, extending all the way down to 50.95. So in order for oil to move higher, the S&P 500 would have to keep moving up, and the probability of that is less than 50% in my respectful opinion, based on the aforementioned comments. So we want to look at all the factors here, guys. We don't want to just look at one indicator and say we've got accumulation distribution, or we've got some other indicator here that is suggesting a single indicator is like doing single market analysis. We have to look at the broader ranges first of all, then we have to look at the intermarket correlations, and we also have to take a strong study of price. So when I look at all of these things, oil is getting a boost because the stocks did, but now the stocks are going to have to stand on their own 2 feet. They're going to be taking the training wheels off, so to speak, because now the stocks, they've largely made a move up on the understanding that the Fed is going to continue to cut down to zero. Now the Fed has flip-flopped and said, no, they're not doing that. It's going to be data dependent. And with the non-farm payroll number on Friday, that's not overly supportive of that position that equities are going to go much higher from here. Now, as we start to move into our main Forex pairs, before we do that, we do want to make sure that we're at least looking at Bitcoin here, guys. There's a lot of different people have a lot of different opinions here, but I always tend to go for price. And basically, I've got a line drawn in the stand down here. We've talked about this every single week. I've included Bitcoin in the analysis because I believe there is something there. So if we look at the low here around 77.89 during that Zuckerberg testimony, we pushed slightly below the range. And then you can see the buyers came right back, storming back in. But we can also assess here too that the benefit of having these verified zones cutting across here, it warns us that if we're buying, we still have to clear this area up here, and we couldn't do it. So one could argue that Bitcoin is still bearish, but in my respectful opinion, once again, we're trading in a range, and it's still a strong buy on dips. Now, again, there's a lot of people have a lot of different opinions when it comes to Bitcoin, but we can't ignore the fact that we've got somebody here or a large group of people that are buying it. Okay. Now, when we look at the Euro US for this coming week, we can see that the Euro has had pretty strong buying down off this initial verified support zone that we have built into the VantagePoint software. That's coming in at 110.73. We couldn't penetrate below 110.73 and up it went. But you can see that we're very clearly here, we are stalling up at this level. Now, the euro, again, needs to get going. In my respectful opinion, if the equity markets sell off, then we could see the euro rise. I'm seeing a stronger intermarket correlation to the equity markets and the S&P 500 and the euro, or an inverse correlation to the euro, and a more positive correlation to the dollar. Now, this is not 100% correlation either way, but usually when the equity markets crash, the euro goes up. So this euro could be another warning sign to us that not only is the S&P 500 getting ready to move lower, gold is getting ready to move higher, and the euro may very well follow that up. Now, we don't have a completed medium-term crossover or medium-term predicted difference cross over our long, but it is trying to cross here, so we'll continue to monitor this coming week. But right now, when we look at this, we can see here that our key vantage point level is 110.98. If we bring in our long-term predicted, this is the area you really want to watch to start the week, guys. Can we hold above 111.39? We keep challenging this area, and on Friday we pushed down below it, but we managed to close above it, but we could not clear that verified zone. That verified zone is still holding price from breaking out. Now, with the US Swiss franc, another one again that's very confusing with this current move on the S&P 500 that's broken to the upside. I believe it's about 90% Fed induced on that move, because the usual suspects, which is US Swiss franc and US Japan, are moving in the opposite direction of the S&P 500. So that is a huge warning sign to me that the S&P 500 may not be what it appears to be. So we've got some good support down here, but the indicators are still suggesting US Swiss franc is going lower. Our main resistance point, that's coming in at 99.15, and to begin the week, you want to watch this level very closely, the 99. If we start breaking up above 99, then we could go higher. But if we continue to hold below the 99 level, then this pair is likely getting ready for a bigger move down. That would mean the S&P 500 ultimately is likely going to follow. Now again, nothing is 100% because we've got constant interference from this Fed. But again, I think the market is really struggling with the idea that there's going to be a trade deal between the US and China. They're struggling with a number of different things. So we look at the indicators from VantagePoint, our predicted RSI sitting at a breakout point, suggesting that we could be getting ready to go lower. Now, this support zone down here at 98.39, that's the area you want to watch. Be very careful around that level. Also, this level right here, just below around 97.90. Now, this pair is, again, sitting, consolidating inside a very identifiable range. When we go like this, we can block out this area and say, okay, we are not trending up, we are not trending down, we are sitting inside of a range. We've been in that range for months. Again, guys, when you hear people say that because something's not moving up, it's going to move lower, that's usually not factual. The market is only trending 20% of the time. 80% of the time, this is what it's doing. Just like gold, it's perfectly normal here, guys. Don't get it confused with something else. Remember, the market does not trend 80% of the time. So right now, we're within that range, but if we break down below these levels, we could be getting ready to make a move much lower. Now, with the pound dollar, again, more volatility around the election that's been called. The pound dollar is really struggling up around this 130.12 area. I anticipate that this area is probably going to hold at least for now. But if we start breaking out above that area, we definitely want to make sure we've got another price target. If we break above that level, we've got a price target up here that's going to change considerably. Now, that price target would then turn around and we would be looking for a move back towards this level up here. Let me just drag this bar over here. We can see that we would be looking for a considerably bigger move, probably towards the 132 area, 132.80. But again, that's a tall order at this particular time. So we'll continue to monitor this. But again, right now, if we look at the key level, 127.86, we're looking for the market to hold above that level. As long as the market is above 127.50, 127.86, then longs are still viable. We can see the medium term crossing the long-term predicted difference is trying to make a move here to the upside. So we'll continue to monitor it. But the risk is very high here for longs at this particular level. Now, with dollar yen, we've talked about this one extensively over the last couple of months here. And again, this is a classic case. When we look at something that's consolidating along a range here, we can see that the dollar yen had a big move to the downside prior to the non-farm payroll. This area around 109.30 that I've been talking about for the last couple of months is simply too hard for this to break. Now, when we look back a little bit in price, where I was going back here, you'll see that this move is absolutely identical to the move on August the 1st of this year. Verbatim to the number. So the dollar yen comes right up to that number, to the number of August the 1st, and then crashes lower. I think that we should be respecting this particular move, and this could be, again, a leading indicator that gold is getting ready to break out to the upside. The S&P 500 is getting ready to break lower. Oil is getting ready to break lower. All of these things can spin off of this dollar yen trade, this failure at this 109.30 area. So we'll see if this pair can recover. If this pair can recover this week, then gold will likely move lower. The S&P likely move higher. But my optimism on that at this particular time remains heavily guarded. When we look at the the indicators from VantagePoint, the predicted differences, they are anything but oversold here, guys. They're actually pointing towards a potential trending move. So as long as we can stay below this 108.40 level, get below this level and stay below this level, then we're likely going to target a little bit lower, back down to towards the 106.50 area. Now, with US Canada, once again, showing the power of the verified zones. Once again, I've talked about this area between 131 and 130, and I've been very adamant about here that the buyers are going to come back in. I've made the argument about the Canadian election. Canada now has a minority government. We've got oil prices that really are not strong at all, slowing economy, and then of course we've got the Bank of Canada confirming everything I just said. The US-China trade deal, they're concerned about that. Bank of Canada didn't cut this past week, but they certainly hinted that they might be in the near future. That hurt the Canadian dollar, so our resistance to start the week is going to come in at the high, which is going to be 132.08, and our low end of that is going to be our VP level. We want to see if we can get above our critical vantage point level. Now, to get that level, we're going to click on our F8 and we're simply going to look at this pivot area here, and this pivot area of 131.31, and we've got a verified zone down at 130.42. This area here, when we look at this, this is what we're dealing with for this week, guys. Let's simplify our trading, shall we? We block out a piece here and we say, okay, this is where we're trading in this particular range. The last thing you want to do is complicate your trading with a number of different indicators. We want to keep it as simple as possible. Our indicators here, predicted MACD, predicted differences, they're all saying that it's going higher. So if it moves lower, that's a buying opportunity. The key thing is know your levels and play these levels. So again, long still slightly favored on US Canada, but again, we have to see what the equities and oil do, right? The S&P 500 and oil. Now, with Aussie US, once again, we are up against a very stiff resistance area. That high coming in at 68.94. Once again, when we back these charts out a little bit, you can see that we've got a number of different resistance zones here that the market is desperately trying to get above. Now, the Aussie dollar got a bit of a boost from the RBA this week, saying that they're going to be on hold. They're not hiking and they're not cutting, they're on hold. But now, let's look at this from the FOMC viewpoint now that we have that information. Now the FOMC is basically saying they too are on hold. So Aussie is now going to be at the mercy of the S&P 500 and some of your commodities. If they move like oil and the S&P 500 move lower or crash lower in the next several days or week, then the Aussie and the New Zealand currency are going to follow. It's the same trade. So we want to watch this area up around 69.20. And with New Zealand, we want to look at the same type of trade here, guys. We want to keep it very simple. When we look at the New Zealand dollar, you can see this very, very stiff resistance coming in at 64.50. The market hit that level to the number on Friday and then failed. Now again, the indicators are still mildly bullish, but we must get above 64.50 and stay above 64.50 for at least 2 or 3 days, guys, before we even think about buying at this particular level. The probability at a failure between 64.50 and this upper level up here at 65 is extremely high, particularly if we do get that sell-off in the global stock market. So once again, we've got a lot going on next week, but we should revert predominantly back to range trading. So with that said, this is the VantagePoint AI Market Outlook for the week of November the 4th, 2019.